Have you seen what FUBO's done since our last video? It's about time for us to address a few of the issues. It's time for a
follow-up. It's a follow-up. It's a
to New Club.
Follow-up.
A lot's really happened with FUBO since the last time we put out a video, which was FUBO Part 2. I got somewhere in the neighborhood of 350 to 400 views on that video, and there's a lot of people that are interested in this, so let's talk about it. First of all, nothing I give here is financial advice at all. Do your own due diligence. These valuations that I do, I actually am a business valuer, but none of it actually qualifies as a real business valuation. I'm not showing all of my work, and it would not comply with any of the standards of any of the organizations to which I am beholden. Also, I may give my own opinion of all of this, and I assure you I am giving you my unbiased opinion. However, I may also own these shares, may not own these shares, and that may change at any point in time, now or in the future. One quick correction, though, from the previous FUBO videos. You do actually have a vote. It just doesn't count for a whole lot. Disney actually has control of the company, and you really don't have any kind of vote whatsoever. So let's get to it. One of my favorite quotes is by Tony Hsieh. Things are never as bad or as good as they seem, which is from his book. And the reason I like that is that if you dig into the personal life of Tony Hsieh, you'll actually find out that as successful as he was, and he became far more successful than I or many other people ever will, he also made a lot of really, really questionable decisions, both in business and in his personal life. So he kind of lived on the edge. But this is my favorite quote of the day, the second one. How bad or good things seem is loud rhetoric to distract you. To make money, you're actually chasing capital flows and positioning accordingly. That's one of my favorite quotes of the day. But let's go to the real issue here. We believe that our share price has not yet reflected the operational progress we have made, nor the intrinsic value of the combined business. I hope today's updates help to close that gap. Co-founder and CEO David Gandler. So FUBO came out with a press release. They did the 1 for 12 reverse stock split. And then they came out with a press release, and I'm going to talk about for a second exactly kind of what happened. They do the reverse split right here where this purple dot is. I use Thinkorswim for my charting. And then the stock just tanks for several days, which if you remember my FUBO 2 video, I actually said it could go up for a little while and then could turn around and come right back down, but I don't know where a stock's going. That last bit is the absolute truth. I do not know where a stock's going. But it was interesting that the stock just completely tanked from this 13 to 14 area, which it never was 13 to 14 in the last little bit. It was $1.50 a share, and then they went 1 for 12. But it just tanked and tanked and tanked and tanked and tanked until finally the momentum somewhat let off, and it crossed these downtrend lines that I just blithely drew here because honestly I don't know. You know, I find myself drawing a line, then drawing another line. And then it crossed, and then all of a sudden, before the market opened yesterday, they put out an announcement. And really, the whole point of the think about it this way. You're the CEO of a big company, and you do this reverse split, and you know all the issues that we talked about in the FUBO video and that I presented, but you do this reverse split, and then the stock tanks anyway. So this is the press release that they put out. There's a bunch of stuff in here, a bunch of numbers, and I'm really going to kind of talk about that a bit. So here we are. there's a lot on this slide. This is probably actually the most important slide that we have here. If you read the actual press release that David wrote with the help of their press people, there are a lot of confident statements in that thing, and also kind of an air of resentment. They make this statement that wholesale fees will contractually improve. They make this statement that they're optimizing channel lineups. They make this statement that they're guiding to $80 to $100 million worth of pro forma adjusted EBITDA for 2026, and they're targeting at least $300 million of pro forma adjusted EBITDA by 2028. We're going to talk about both of those things. They project these numbers. I'm not going to really go into these, but positive free cash flow the next few years. We talked about this in the streaming and media area. It's really common for companies to go along with negative EBITDA for long periods of time, and sometimes never become profitable. So, or negative free cash flow. So, positive free cash flow is a really good thing, and those numbers are very good things. They talk about lots of great debt management. It is true that they now have Disney's deep pockets to deal with, so that's good. And this last one was my favorite. They refute the idea of diluting the equity for capital raising purposes. I actually made that point in my FUBO Part 2 video, so I was just curious. David Gantler, I believe, is the name of the CEO. Are you out there watching my videos? Because if you are, I'd love to hear from you. I know you probably won't dial in because being an appraiser, I've actually called publicly traded companies before to confirm a sale and have found out that, the answer always is we're a publicly traded company. I can't really talk about that. But David, if you're out there listening to me, I'm very flattered. What's also important, though, is what's not in the press release, okay? We talked about this in FUBO Part 1 and 2. Truth of the matter is, when Disney came in and they did this reverse split, it devalued your equity because it marginalized the equity holders that were not Disney. You suddenly had a much smaller piece of the pie. Disney did bring in a whole lot of assets, and they did offer their deep pockets, but it all came at a very high price. And we spent somewhere in the neighborhood of 3 months with FUBO stock just going down, 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 down. And if you pull up, like let's just pull up a year of, or maybe 6 months of FUBO here. Maybe a year. Yes, there you go, 6 months. The stock was not $50 a share during that year, or during that 6 months. This is a split adjusted price, and so you have to be a little bit careful because this is kind of, I refer to them as fake numbers. It never really was these prices. It just fell until it ended up somewhere in the neighborhood of $1.15 a share or something like that. And then they did the reverse split. And look, fundamental theory teaches left and right that a reverse split or a split of any kind actually has no effect whatsoever on the equity other than to affect public perception of the stock through the price. That's all. And it really is only a human nature thing, the public perception of the price. So the thing is, if I can draw that line, so can everybody else. And it's kind of interesting, the stock tanked and then just a few days ago touched that line and then backed off. And today it's up just a tiny little bit. As I write this, it's about $12.50 a share. We're going to talk about that a little bit more, but what the press release doesn't really do is talk about how your shares got marginalized because they gave so much to Disney at such a high price. As of yet, we don't have any open market share purchases by insiders that I know of. That's also not in there. And there's no share buyback plan. Look, if somebody knows that there is one and I don't, please feel free to comment and let me know. But as far as I can tell, I dug into their latest quarterly report. I could not find any evidence of a buyback plan or anything like that. Which is interesting because the air of resentment that particular press release was written seemed to indicate that we don't believe that our stock is appropriately valued or reflects our operational improvements. Well, okay, that's great. Let's go over here. This is a website that I follow called SEC Form 4. If you are an insider, not a hedge fund, but if you're an insider to the company, you have to file SEC Form 4. I believe it's within 3 days of having purchased. So we don't have anything here that resembles purchases by insiders at all. So that resentful statement of we don't believe that I don't want to put words in David Gandler's mouth. We believe that our share price has not yet reflected the operational progress we have made, nor the intrinsic value of the combined business. Okay, great. How about go out and maybe buy 10,000 shares of your stock when it's $9 a share, right? How about that would break onto the news wires. Maybe a few hundred shares. How about just buy some shares? Instead, what we have is we just have option awards, exercises. They keep some of the shares and sell a lot of them, but we just don't have, right here on the activity board, we don't have any purchases. It's all just sales. And it's been quiet since January. So how about buy, 5,000 shares of the company when it's $9 a share, if you really do believe that it does not that the price doesn't reflect the operational progress. How about this? Boards the world over will approve a share repurchase plan. And what they'll do is maybe they'll actually do the repurchases or not. They'll just approve the plan, and maybe they'll repurchase, maybe they won't. But what they'll do is they'll wave that around. We have a share repurchase plan to repurchase up to 50 million shares of our stock over the next 6 months. Then they'll renew it, and they like to renew it because that keeps the press machine rolling. Well, why not do that? There isn't one. And so, that's just a tool in your tool bag you could use to maybe instill some confidence that we are, we are cared about as far as being equity holders of the stock. So there's no share buyback plan. They give some numerical. They don't give numerical revenue guidance. That's not there. What they do give are statements about how wholesale fees will contractually improve, and they're optimizing channels and stuff. But they don't say anything about revenue guidance. And if you saw our FUBO Part 2 video, you know that we went and made an attempt at valuing the shares, but because we only had 1 quarter of positive EBITDA, as I can possibly calculate it, and I'm a hack, we couldn't really value it by price to EBITDA. So we don't have any revenue guidance to really go by. And this one you need to be careful of. So they project, let me see if make sure I get this right, pro forma adjusted EBITDA. And they talk about adjusted EBITDA a lot, or EBITDA as it's pronounced sometimes. I like EBITDA better. EBITDA, okay, EBITDA is not an actual generally accepted accounting principle number. You start with several different things, but you start with your net income, and then you add back interest, taxes, depreciation, and amortization to get back to this number that you would pay things. It's a bit, how you go about calculating that number has some flexibility to it, but there are some standards, but it's still not a GAAP number. And then adjusted EBITDA, you can then take that number, which is already kind of a first derivative of GAAP accounting numbers, and then adjust it for other things that you think are germane to the equation or not applicable, and end up with this number called adjusted EBITDA. So like, if we were to, EBITDA is kind of along the terms of, hey man, will you take my sister out? Well, you've probably been over at your friend's house. You've probably seen his sister. You know what she looks like. So, okay, I'll take her out. Adjusted EBITDA is kind of like, hey man, will you take my cousin or my sister's cousin out? Well, maybe you haven't seen his sister's cousin. Maybe she looks like y'all, and maybe she doesn't. I don't really know. So that's actually a kind of a second derivative. And then there's pro forma adjusted EBITDA. In other words, will you take my sister's cousin out, but you have to wait a year to do it, to take her out. So in each of these things, I'm not saying that the company's lying to you. That's not what I'm saying. What I am saying is that you've got to be really, really careful with EBITDA projections, especially when they become adjusted pro forma EBITDA projections, and we get strong statements about how revenue should profit and benefit from these things, but we really don't get a lot in the way of revenue. They've got to know that if they give revenue guidance, that's the way the company's been valued to this point. So there are a bunch of numbers. If you saw our FUBO 2 video, you know that we did a back-of-the-napkin valuation of these FUBO shares. There is a statement. Let me go back just a second. There's a statement here that says, let's see, points in the FUBO, right. They make, right here, refute the idea of diluting equity for capital raising purposes. Okay. Okay, great. So the equity won't be diluted for capital raising purposes. But we do know that a lot of the compensation that is paid to the people who work at FUBO, especially the executives, is through share-based compensation. So at every turn, the amount of shares at FUBO have increased. So, okay, you're not going to do it for capital raising purposes. That's fine, but that doesn't mean that the equity isn't going to continue to be diluted through share-based compensation. And in fact, we should expect that to do so until we see some sort of signal from management that they're going to institute a share buyback plan, even if they don't use it. Until we see them buy some shares themselves on the open market, until we see that sort of thing, we don't know that they actually put much thought at all into the equity tranche. So this is our share valuation. We ran this in FUBO 2, and it's updated now. So if we took the positive EBITDA that they had for the 1 quarter they have post merger, and we multiplied it by 4, they said about 20. I'm sorry, we come up with a run rate of about 24, billion. Add 3 more zeros. They are now guiding toward adjusted EBITDA of a lot more than that, 80 to 100. Now, that's pro forma adjusted, not actual, but they're guiding toward, for the end of this year, 80 to 100 million of pro forma adjusted EBITDA. And they're targeting, which, understand, I can target anything I want to, but they are targeting at least 300 million by the end of 2028. Okay? Those are good numbers. I'm not being hypercritical here. Those are good numbers. That's a lot more than $24 billion worth of EBITDA. Or I guess it's million, sorry, but it's a lot more than that number anyway. And so what that does, if we now take the number of shares that came from the non-proxy proxy, as I call it, the last indication we had of how many shares they had, divide it by 12 because we had a 1-for-12 reverse split, and we go with the same revenue annualized that we had, we come up with these figures here. And we talked about how the comparables aren't of that much use, but we come up with this sort of thing here. Let's concentrate on this $13 to $56 range right in here. If the management is correct about the fact that they're going to have a lot more EBITDA. They're going to go from a company that up until this past quarter had negative EBITDA. And now not only are they going to have positive EBITDA, but they're going to have a lot of it. That will reprice this company from this lower share range of $13.42 upward. Where, I don't know. Anybody who tells you, because you got to remember, value is an anchor. It's not an actual determinant of where publicly traded prices are going to go. If the company really does have channel optimization and content additions and things like that, which I don't see why they would lie about that. It makes perfect sense to me. That would raise this revenue number, which we know that the share count is going to continue to go up until there's some further notice. But that would mean that the share price should be priced upward from this $13.50 number. As I speak, FUBO is currently $12.50 a share, roughly. We talked about that. It got all the way down to somewhat below $9 a share right after, a few days after the split. I think that was a technical thing. The one thing you have to really be careful of, though, is that if you can draw a line, so can everyone else. And even though these are fake numbers back here over the last 6 months, the price ticked off of it and backed up. You have heavy volume right after the split as some people sell off their shares. I've speculated endlessly as to why that happened. It could have just been people going, hey, my shares are high, I'm going to sell them. And they weren't really. I don't know. But we then end up with an area here where suddenly, boom, you get this announcement and, high volume yesterday and especially high volume today, and we're at about the 1250 area. If this were me, now, you are a different person than me if you're watching this video. You're going to have a different both willingness and ability to bear risk. So I am absolutely not telling the people out there listening to me what to do. I'm not. But if it were me, what I would be doing is paying attention to FUBO, because we have a lot of action at the moment, a lot of volume. I would be watching this very closely as it relates to this line right here, because I'm not really in the business of buying a ton of volatility just to have it. I need stock prices to move up. I like the things that the leadership of FUBO said. I can appreciate the fact that they put out a press release and said, because they were just probably resentful that the stock had fallen all the way down to $9 a share. Would have liked to have seen them buy some down in there. Would have liked to have seen several things. Would still like to see those things. But if it were me, I would be watching this for a break above that line, and I probably wouldn't touch it until then. The line's all the way down here where we are, because I need to see that stock go up. This is an event, them putting this press release out there, and I can appreciate it. But I would be watching this really closely. If you have to buy it, and you have to buy it right now, use a close stop. Do not lose more than 7.5% of your money. 7.5%, why? Because it's halfway between 10 and 5%, and it gives a little bit of cushion so that if you end up with a stop loss order entered on a hard fall and you lose more than that, it kind of builds some cushion in. Do not lose. Put a stop in there and raise that stop tightly as you go on this if you have to buy it right now. I probably won't be buying it right this minute, but we'll be watching it and could be buying it at any point in time. That is what I think about it. And I really appreciate you watching. Please consider subscribing, and we will see you the next time we do a